Singaporeans aren't putting their money to work. An HSBC survey shows while they have good financial habits like saving, they are weaker when it comes to financial planning and investing. That's earned Singaporeans a moderate score on the bank's Financial Fitness Index, which consolidates scores on these 4 areas.
We noticed that on average, our respondents have an average score of 66 out of 100, which is considered moderate. The biggest barrier for a customer to invest is actually financial knowledge as well as the financial planning.
If you look at households' financial wealth in Singapore, 37% of it is in cash or bank balances. If you compare with the US, that number is 14%, 1/4, in Australia 23%. So it is true, people tend to invest less. Why is that? I think a big part of it is financial literacy or lack thereof. And part of it is driven by the fact that over the last 3 decades in Singapore was probably enough to just invest in local real estate to build up wealth. And the question is it going to be enough in the next 3 decades? And nobody knows, but from where I sit, I think it's difficult to suggest to someone to take that risk to kind of invest everything in one asset class.
But that could soon change. Funding in wealth tech has risen from $23 million in 2017 to $161 million in 2021. That's a 7-fold increase.
The actual market's getting bigger. People are getting perversely younger. So we've got more Gen Z, millennial type customers and users here in the middle class of Asia than anywhere else in the world now. So those people like to use mobile, and therefore you put the two together, more wealth, younger consumers, and this becomes wealth tech.
Online digital tools like robo-advisors and financial advisories could democratize investing, lowering barriers to entry to an increasingly tech-savvy population. Many have low or no minimum sums for opening accounts. They also plug the financial education gap by providing tutorials and insights. And because much of the process is self-service, costs can be lower. That's empowered mass market consumers that traditional wealth management models leave out.
You want to have your eggs in many baskets. You want to have some stocks, you want to have some bonds, you want to have some real estate, you want to have some gold, and you want to have it across geographies, and you want to have it across structures. And that is very difficult to obtain in old world. While today, with Plus, it's actually very easy. In a few clicks, you can actually build a very, very diversified portfolio.
Traditional banks have taken note and are making moves in digital wealth management. Some have launched digital wealth planners that allow consumers a coordinated view of all their finances, including bank accounts, loans, and stock holdings. Apps are also being enhanced to allow customers to open accounts digitally and actively invest on their mobile devices.
We try to provide empowerment as well as convenience. So one thing we do is using our global wealth expertise. We put in the wealth insight in our mobile banking so that the customer can access it, increase their financial knowledge as and when they want to. They can open an investment account on the mobile banking in a straight-through process. They can browse through the app to look at the portfolio in terms of how it looks like today, as well as look at new investment opportunities such as unit trust or, let's say, FX or equity.
While customers increasingly have access to wealth managers through online services like WhatsApp and WeChat, banks say there is no replacement for the human touch.
So the wealth manager are actually an essential part of the whole wealth management. The reason is that customer can access the mobile banking at their fingertips, right? They can actually look at the portfolio, they can do a simple transactions on their go. So the wealth manager become very critical to be there to guide them whenever they have questions or whenever they are in doubt.
Experts say the expansion of the wealth tech sector is an opportunity for banks to reposition themselves as leaders in the field. One way to do this is to focus on providing more personalized platforms for clients and digitalizing processes to lower costs. It will also pay for banks to invest in younger consumers now, even though they may have less capital than the baby boomer generation.
The banks have to sort of balance up. How do I invest in the future generations, Generation Z, some of the younger millennials? How do I invest in Gen Xers and baby boomers at the same time? Bring the two together under a digital umbrella.
While all signs point to wealth management riding the digital wave in the future, having access to your wealth portfolio with a few clicks comes with its own risks. Privacy and cybersecurity concerns will become increasingly important.
I'm really concerned that we're becoming digital very, very quickly. The people who will be excluded and the ones who will be pinged by the fraudsters are going to be the ones who are the less educated and probably the less rich as well. So it is a community, social responsibility we all need to fulfill.
Ultimately, whether you choose to manage your wealth digitally or the traditional way, experts say not investing in these times is the bigger concern.
Market volatility is always there. The question is it big or small, right? So what we feel is that we can try to help each other to build a financial knowledge, adopt a good financial habit, and review the financial planning on a regular basis, plus invest consistently, so that we can actually improve the overall financial fitness and we can deal with all the uncertainties as it comes.
I agree that there is a very, very obvious need for people to take a bit more ownership of their money. I think with an inflationary environment where we are today and people think that this is may last for a long time, it's even more important for everyone to think about the fact that you can't simply have money in a bank account. You need to actually take a bit more of an active approach to think about your retirement future.